Pretty much everyone in the United States deals with some type of tax reporting, whether that's withholding out of their paycheck or money they have to pay into the state that they live in, or their federal 1040 that they pay. That is tax reporting. And we pretty much all have to participate at one level or another. But very few people understand the concept of tax planning and what that really means for you and your financial future. We're going to talk about the differences between the two, how collaboration between a wise investment counselor and a good quality CPA can collaborate to make your life better. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Aaron Rheaume.
Director of Financial Planning, Mr. Rheaume is. Happy to have you along in here, Aaron.
Thank you,
we
Joe.
are going to talk about some of my favorite things today, favorite concepts. The concept between tax reporting and tax planning. So let's break this down simple. When we talk about tax reporting, Aaron, what is that?
Tax reporting is what you're doing right now. It's right now and what you're doing.
Right now, because we're talking right before April 15th.
Correct.
Okay.
Yes. And tax planning is what you have to do prior to year end. So
Now, that's an interesting concept. What you have to do. Really, do I have to tax plan?
you don't have to, but you should.
But it's what you did, right?
Correct.
It's what you did. So think about this when you think about those two. It's really the story that you want to tell, right? You know, I just got to go on a vacation and was out with the guys doing some things, and I got to tell the story, right?
Yes.
Now, there's going to be a camera that's going to show the reporting, right? We don't know that the story is going to match the reporting, right? I could have just shown up and walked around and lollygagged, right? And came up with a wild story, right? And that's called cheating in the IRS's case, by the way, right? You know, Fortunately, there are pictures that will, verify, said activities and what we were able to do. But that really is the difference. So tax reporting is what's done after this fact.
Yes.
Right? And tax planning is done what happens before the year ends. Right? So which one at the Financial Enhancement Group do we focus on?
We are primarily focused on tax planning.
Primarily, almost entirely.
Correct.
Right? But the tax reporting we have a CPA, Brett Spangler, who's part of our team. He's got taxes that he does in a different entity. We work with Ben and at eStep, a doctor and company, and Michelle Skeen, Huth Thompson, Link Perkins up in the Lafayette area, Mike Layer down in the Indianapolis area. We've got CPAs that we really have great collaborative relationships with. And what do I mean by collaboration? Well, it's real simple. Cooperation is when I say you do this and you do that.
Right.
Right? Collaboration is I go, what do you think about you doing that and me doing this? Right? That's where you really have to have it. And I will tell you, in my world, in my experience, there's not a lot of collaboration that goes on between the investment advisor, the wealth manager, and the tax planning. Right? The person who's doing the tax reporting, rather, the CPA. Now, here's the odd part. You ready for this? I have a lot of engineers. As far as I know, I have the largest percentage of engineers of any firm our size in the country. And I'm sure there's somebody that's probably got more, but I've just been very blessed between the Lafayette area, the Indianapolis area, the Anderson area to have all of these engineers, including my father-in-law. You know, a lot of people at our church, they jive with me for some reason or another, right? A lot of them want to do their own taxes, right? And so many of them have come to us because they didn't understand that they weren't doing tax planning. They were just doing the tax reporting. It was like going through the entire year, believing they were doing everything right. They were saving money. They were putting it into their 401k, but they didn't understand necessarily the things that were going on, the nuances and the tax code changes and what was going to happen as they began to age. So we still have people, and there are people who say, well, Joe, I want to do my taxes. Well, we have no problem with you doing your tax reporting. In fact, if you want to be your own fiduciary and you want to do your own tax planning, that's fine. Listen to the show. Go to our website at yourlifeafterwork.com. You can get a lot of our articles, other radio shows like this. Sign up for my podcast. I'm happy for you to be able to take what we're doing and do this on your own. I will always recommend, whether it's us or somebody else, that you get somebody who is not you, right? Who is a professional, hopefully, but just a second set of eyes that's helping you think through some of these strategies in terms of where they are. So, Aaron, we've got about 5 primary tax planning strategies we use. What's one of your favorites?
Roth conversions.
Roth conversion. So talk to me, what does that mean?
That is making sure we're being the most tax efficient with the dollars that we have in front of us. And it's looking at the future of how dollars are going to be taxed, whether you're in distribution, whether you're getting ready to take money for an income. We want to make sure that we're doing the best that we can with the dollars that are in front of us. And so the Roth conversion allows you to look at your marginal income bracket and say, am I going to stay in this bracket throughout retirement, or do I have a possibility to jump into a higher bracket when Social Security kicks in, when potentially required minimum distributions have to happen at age 72? And so again, we're trying to make the best tax efficient sense with the dollars that we have in front of us.
So when he's talking about the best tax sense, the word that we use for that is called bracket bumping.
Yes.
Right? And so, again, most people don't understand how their taxes work. One of the classes that I taught at Purdue, and inside of the capstone course, was reading your return, right? And I'd make the kids bring in their tax return of their parents or somebody else. You know, it's funny, some of them would have their Social Security numbers marked out. It'll be okay, right? But we would go through and learn to read that return. So just real quickly, what happens here is when you look, and I'm back on my whiteboard again. If you're watching this on a video, if you're on the radio, remember you can always go to YouTube, go to our website at yourlifeafterwork.com to get it. But what I drew was a series of stair steps. And Aaron used a word called the marginal bracket, right? The marginal bracket is where your last dollar is actually taxed at. So assuming you had earned income, we'll just look at it that way. That's referred to as your marginal bracket. And when we do planning, we have to do it based on that marginal bracket. When you get your tax return, what you need to look at, if you go look, most people will look at what's called AGI, or adjusted gross income. That's not the key number for understanding this. It's adjusted gross income minus either your standard or itemized deduction, and that is going to get you to what's called taxable income. That taxable income is very, very key because you don't want to pay taxes. Aaron doesn't want to pay taxes. Trust me, I don't want to pay taxes, right? But if you think about that fiduciary focus, right, the four things you have to focus on: risk and volatility, fees and expenses. Remember, and those are two different things. Taxes today and tomorrow, right? There's two T's in that. Taxes today and tomorrow. Never forget real return or inflation. Those are the four. So I know my taxable income. So that first dollar is going to be taxed at 10%. So that would be the marginal rate. If you're married filing jointly, and these are weird numbers, but it's about $19,000 this year that you have that's taxed at that 10% bracket, right? And then you're going to take this stair step, a 20% jump to 12%. And that's going to be all the way up to about $89,000. Again, married filing jointly, and don't get caught up in the numbers. Just understand the concept. What we'll see happen is people who will come in and they may only have taxable income up to $60,000.
Yes.
Right? Because they're not taking Social Security yet, or they don't have required minimum distributions. And listen, ladies and gentlemen, I get it. Aaron, you don't want to pay more taxes today than you have to,
No.
right? We get our K-1s. It's a blessing, except for a few days a year, right? And it is there. But let's say you're at $60,000. This is where Aaron would talk about that Roth conversion, where we take money from an IRA that would be fully taxed later on, and we take it to the top of that bracket, so we could do a conversion of, let's say, $30,000. At the 12% marginal bracket, which I assure you is going to be one of the lower brackets that most of us are going to see in our future. If you believe in and subscribe to the fact that you're married and one of you will die, there will be a period of time where you're filing as an individual, and then all of these numbers begin to get compressed. The percentages don't change per se, but the amount that you can change does. So if something happened to me, right, typically the guy dies first, Barb's IRA and 401k value doesn't go down. Right? It's not like I'm leaving that to somebody else, but before she's gone. So all of a sudden, she still has the same IRA that was there, and she's got these required minimum distributions that will have to come out at some time as a single individual, which could easily propel her to the next bracket, which is 22%. So Roth conversions and bracket bumping. If you got all that, good on you. If you want to do this on your own, I totally get it. I understand it. When you're ready for a fiduciary, though, understand that that is our business. And if you want to give us a call at 800-928-4001 or go to yourlifeafterwork.com, Aaron and our team are more than happy to sit down with you and to walk you through this concept, bracket bumping, if you will. All right, we got time for one more quick one.
I like appreciated assets.
Okay, what about appreciated assets?
And teaching people how to gift those. So there are a lot of times to where we have people that come into the FEG office where they've owned a stock for a long period of time. It's highly appreciated, meaning that there is a lot of gain inside of it. And
so we're talking about non-IRA money in this
yes,
instance.
Non-IRA money. And most people are charitably inclined, but they write checks, and there's a different way to do it to be tax efficient, and that is looking at donating an appreciated asset.
And we rarely see it done. If you knew, on our behalf, we open up accounts for churches and charities. I do it on my dime, right? No trading cost. And if you knew the number of places, larger institutions that had never understood this concept,
yes,
it would shock you. I mean, it really, really would. So walk them through that again. Let's say we owned a fruit company that we bought back in 2006. So we have this fruit company, right? But I don't want to get rid of my fruit company, but you're telling me I should gift it instead of writing a check.
Yes.
So what would happen?
So what we would do is we would pick out the amount that you want to, let's say, donate to the charity. Could be $5,000. It could be $1,000. That's immaterial. But once we find out the number, we would relate to how many shares that would be. And so let's say that fruit company, you bought it for $10 a share, is now worth $100. So there's a $90 a share difference. If you were to sell that and donate that on your behalf, you would pay the capital gains tax on that $90 difference. What you're able to do is take that same fruit stock and say, I want to transfer this to the church, the charity, the non-for-profit. They are a 501c3. They don't pay tax, so you donate them that fruit stock. They get the $100 a share. You get the deduction if it makes sense inside of your tax return. And what you can do is repurchase that share and raise your basis.
Beautiful and brilliant.